Good morning. Morning, everyone. Thank you for the introduction, and thank you for the opportunity to come and present to Aifa, one of the leading associations of mutual fund distributors in this region. Very happy to be here. Normally, in a lot of these sessions, you will get a lot of discussions about what is happening in the industry, what is happening in India, the state of the economy, what could happen. From our side, what we thought, and given that my background is more in consulting, I thought I'll give you a little bit of a perspective of what could happen in the future, in the next 5-7 years in the country, and therefore what will be the implication on the asset management industry, both for manufacturers as well as for distributors. So I'll cover 4 or 5 broad areas. The first is, what are some of the key learnings from global players? Are there some new investment styles, investment philosophies, investment themes that we are seeing globally that can be applied in India? Second is on products. A lot of discussion has taken place around actives, passives. Will passives take over the role of actives? What will be the future over there? Third is around technology and analytics. What is the role that this will play in the industry? How will this change in the coming years? How is the ecosystem developing? Fourth is around customer segments. A lot of new customer segments are entering this market. What is the role that, how will income distribution change? What is the role that distribution plays in all of this? And most importantly for all of you, how will distribution expand? Today, there's only about 4 crore unique investors. There's about less than 1.5 lakh distribution capabilities in this market. How can that significantly expand? So let's start with some global learnings. So when you look at some investment styles, investment themes that are beginning to emerge in this market, there are 3 broad areas that we see. First is on the introduction and use of behavioral finance in the field of investing. The world is moving towards where they're beginning to use a lot more of behavioral finance in this area, because what people are realizing is, in economics, all of us were taught, right? There are 2 simplifying assumptions. One is that human beings are perfectly rational. Second, markets are perfectly efficient. Right? But both are not really true. Right? Human beings are human beings. I would not call them irrational, but they are swayed by greed, sentiment, narrative, fear. They do play a role. And what is the market? Market, at the end of the day, is a collection of human beings expressing their vote on a stock or a security with a price. So if you ignore the fact that there are human beings at the end of this, and they have different ways of making decision making and their biases, you're losing out on an opportunity. So when you combine economics and behavioral finance, you actually create something that is even more powerful. The second is the use of quants. So here, how do you use data? How do you use statistics? How do you identify patterns to be able to create investment theses? Is another important area that is developing. And the third is on the use of macros. So macros is not only GDP, inflation, current account deficit. It is actually about the themes in the market. Where are we in the cycle? What is likely to happen with cross connections between economies? So if semiconductor manufacturing shuts down in Taiwan, what is the impact of that on the second-hand auto market in the US? Right? These kinds of cross connections are very important to also understand. So let me give you some examples of how companies have used these themes and what they have done with it. The first one is on behavioral finance investment. So here there's a very interesting company called AQR. It actually stands for Applied Quant Research, but its founder, Cliff Asness, actually used behavioral finance. His professor was Eugene Fama, the founder of the efficient market hypothesis. Cliff Asness himself said that, I think you are wrong, and let me found a company to prove that you're wrong. So what he did was, he actually founded a company which used behavioral finance, which basically said that investors' behavior leads to, wrong behavior of the investors leads to reduced returns. Can they actually use that behavioral gap as an advantage? So what they basically did is, they were the pioneers in behavioral finance, and smart beta investing. They put together economics plus behavioral finance and created significant value. They've now made about $120 billion of AUM in this business, just by doing that. They run about 40 different strategies across equities and AIFs. Their fundamental theme is how do you use behavioral finance to create outsized returns. If you think about quants, very interesting company here called Renaissance Technologies. Many of you may be knowing legendary trader Jim Simmons, who founded this almost 40 years ago. He had a very simple hypothesis. He said, retail investors like to trade in the market. They will lose money. I will stand against them. Today we have data. In fact, SEBI publishes data which says that about 90% of retail investors in the F&O lose money. A few make even lesser returns than FDs. Right? He had this insight 40 years ago. And he basically said, I will use data to identify where are retail investors taking positions and stand against them. So almost 20 years ago, when people had not even heard about things like data warehouses, he had a petabyte-sized data warehouse that was using data to track patterns in the market. The third is on macros. So this is really about how do you use data beyond just GDP, inflation, current account deficit, the standard inflation metrics, etc. So a company called Bridgewater, all of you will be probably knowing about this, Ray Dalio. What they have done is done extreme metricization. So they metricize everything in terms of what is the impact of one industry shift in one country and the impact of that in another. Increase in copper production in some market, what is the impact of that on gold in other markets? All of these aspects they are looking at very carefully, putting data around it, trying to identify where in the current cycle are different economies, different companies. Are they in a reversion cycle? Are they on a momentum cycle? So usage of these macros and data around macros is actually their critical aspect. And what they have done is they are using these algorithms, back-testing them, and then applying human decision-making on top of that to create returns. They've built obviously a $200 billion hedge fund as well now on this. But if you look across all of these three, AQR, Renaissance, Bridgewater, they have all become among the top hedge funds in the world. And when we look at the investment styles, typically we benchmark with hedge funds. Because for them, it is purely about the investment strategy. They live and die with their investment strategy. So understanding them and their approach is actually very, very important for us. Second, if you look at product strategy, right? Most people tend to think of products as either active or passive. Right? From our perspective, we look at it a little bit differently. So what we say is there are two dimensions. The first is the selection of companies that you will have in your portfolio, which is this y-axis, which is the strategy. Is that passive or is that active? Second dimension is the one on top, which is your implementation, or what percentage of that company is in your portfolio. What is your allocation strategy? Okay. So selection and allocation. Both can be active or passive. Let's say if both are passive, the one at the bottom left, this is your typical index fund or an ETF. Right? What is your selection strategy? Simply top 50 companies in the stock market. What is your allocation strategy? Based on market cap. That creates a simple index fund. That itself, by the way, you'll beat most of you, maybe around 50% of fund managers, right? Because of one thing, it has discipline. It does not care what other fund managers are doing. It does not look at what is happening in the market. It doesn't care even about the quality of the company. If it is there in the index, it will invest. Sheer discipline, right? Now, if you can take that discipline, which is on the allocation side, but have more active strategies that you want to deploy. Let's say you want to deploy a Warren Buffett kind of strategy. I want high revenue growth companies, very profitable, available at, let's say, PE of less than 20. You can create an active selection strategy. Your allocation can be again on passive, right, which is simply on market cap basis. Those create your smart beta, rule-based kind of quant funds. When both decisions are active, Then you have your pure active funds. Right? This is typically where most of the industry will create active funds as well. Here, our concept is you should create an active fund when you have a reasonable chance of outperforming the index. If you do not have that confidence, then you should not necessarily launch an active fund. Right? An active fund should have a reasonable chance of beating the index. So how can an active fund beat an index? There are two possible sources of that. First is index is always backward looking. Companies come into the index after having performed well. Companies that are going out of the index will still stay in the index for a while. Right? So a good active manager should be able to look more at the future. And if he's looking at the future and the kind of trends that will be more in vogue in the future, you can create better returns than the index. That is point number one. Point number two is the index does not care about the quality of companies. Right? If it is a commodity, if it's a cyclical company, PSU, if it is in the index, passive will invest. Right? If you can actually look at the quality of companies, better governed companies, better companies with better future prospects, good quality management, again, as an active fund, you can actually do better than the index. So there are reasons why active funds can still do better than the index, and these are some strategies we've also seen which have competed well with passive, and those are the ones that we will also be investing in. And then you have those funds where you have active in terms of allocation, but your selection is passive. This is typically your asset allocation funds, BAF, etc. will come in over here. So from our perspective, we look at it as a slightly more nuanced version of active versus passive across two different dimensions. The third area is around technology and analytics. And I believe over here that in the next 5 to 7 years, a lot of impact is going to come because a lot of work has already been done in India in this area. UPI, Aadhaar, eKYC, GST, DigiLocker, all of these have already come together. The railroad has been created. Now you can build a lot of engines and run on this railroad. So let me give you some examples of how technology can play a role in this sector. So a lot of people would have talked about ChatGPT, generative AI. See, a lot of this thing is, a little bit of it is hype, but a lot of it is also real. Okay? Today, our investment teams, research teams have to often follow investor calls, transcripts. To be able to query those and to be able to get those in a matter of seconds is something that GenAI can do. Right? In terms of marketing automation, there's a lot that GenAI can do for you. So it can reduce the time and cost in many of our today's processes. These will come into being in the future. The second is blockchain. Right? Now, a lot of your use of blockchain has been in digital currencies, in crypto. But look at the asset management industry. Right? You have investors, you have the RTA, you have the AMC, you have the fund accountant, you have the custodian, you have NAV declaration, AUM calculation, and then it goes back to the investor as well. Right? All of these are different counterparties, each who depend on a trusted source of data for the previous step. It's a perfect use case for blockchain. Right? So in the near future, this is a technology that can have a huge impact on this sector. Third is something called account aggregator. I'm not sure how many of you have heard about this, but this is actually a landmark evolution in the Indian financial services space. Let's say in the past, if you wanted to take a loan from Bajaj Finance, you would have had to get 6 months of bank statement from your bank, provide that, and then a loan could be made available to you. Today, based on your consent, you can make that data available to any financial provider that you want. So all you do is you have to provide a consent. Your bank is obliged to provide that data to the provider that you want, and it is already sorted and analyzed. So now it's not that the banks have sole control over all of your liabilities. Right? You can make it available to whichever provider you want. It's a huge change. Think about this. Your entire account statement, your FD balances, eventually your mutual fund folios, your life insurance portfolio, your PF balances. All of this can be made available to the partner that you wish to have. Right? Massive change in terms of technology that is coming up. Many of you may be thinking about this open network for digital commerce as an e-commerce platform, which is true. It is fundamentally designed as a competitor to the Amazons and the Flipkarts of this world. But do you also know that mutual funds are going to be listed on this? Right? Your ability to distribute through e-commerce is actually going to get launched. Right? So these are all very important changes that are already happening in this industry. Account aggregator has already been around for about a year and a half in the industry. Right? These will all impact the ability for you to use data, to expand distribution, to create new platforms to be able to onboard customers. So it's very important for you to be aware of all of these changes. So let's also talk about customers now. Right? So India actually has a very unique advantage over the next 7 to 8 years. So what I call the dependency ratio, which is usually the ratio of people in the working age to the non-working age population. Right? It's a simple ratio. So if you look at the orange and the blue bar, right, for India on the left, that comes to about 63%, and 37% is the population which is not in the working age. So the ratio is 63-37. For US, today it is 62-38. For China, it is 67-33. So all three are very, very comparable today, very similar. Look at 2030. What happens there? By 2030, India still stays at 63-37. But look at the US. It's 55-45. Look at China, 53-45. At the population level, these are massive, massive changes, huge changes. There are estimates by the IMF that a 0.01 change in the dependency ratio reduces GDP growth rate by 0.18%. It is a huge impact that takes place. The economy gets significantly hit in terms of productivity. The focus shifts around healthcare, around pensions, and growth rate significantly drops. We are beginning to see that already in some of these large markets. India is in a unique position where that growth is very likely to continue. So where will that growth come from? Right? Who will benefit? That has to reflect also in terms of the income profile of the population, and we're clearly seeing that. So if you look at 2022, the total of high income and upper middle income households was about 117 million out of 310 million. Right? So about 1/3. That actually shifts to about 200 million out of 356 million. That is almost 60%. This is typically the investing population. Right? Here you have a significant opportunity to grow the market. India is growing from a GDP of about $2,500 to about $4,500 in this time period. Causes a significant growth in terms of the amount of consumption, the amount of investment behavior in the market. One very important point is, where are these new customers going to come from? Right? In the last 5 years, about 1.5 crore new investors have joined the market. About 84 lakhs of these are youngsters, people who have recently entered the market. Most people tend to think they've come from platforms, right? Have come 100% direct. But what is the data showing? Only 5% have come purely direct. 95% still need some advice. They need advice because this is a very complex, uncertain market with a lot of product variants, and if investors are not being advised properly, they suffer. If you look at fund returns versus the investor returns in the same fund, there is always a gap, simply because an investor's behavior is playing against him. He tends to trade in and out at the wrong times. Good quality, seasoned advisors can actually help prevent this. I call this the alpha that you generate, that distribution generates. And people are seeing that. That is why they need advice. So then let's come to the final point, which is really around distribution expansion. Right? So what should you do? India is obviously growing, a lot of things, good things are happening, technology will also play a role. What is it that is important from your perspective? So I keep telling all my distribution partners, our friends, two main things. First, you have to digitize. This is an industry where margins are reducing. All of you are seeing that. We are also seeing that. Right? As volumes expand, margins will shrink. It is a fact of life. In all businesses, we see this. Right? The point is, when margins are shrinking, you have to increase volumes, right? That is the other part of the equation. If you have to increase volumes without increasing cost, only way to do that is using technology, by digitizing. So that is very, very critical. The second is you have to diversify. This is very important because it's not that your customers need only mutual funds every day. Right? They may require a term loan, they may need a housing loan, a credit card, a term life policy, maybe a health insurance someday. Can you provide all of these and benefit from all of these? Each is a different type of revenue. Some create liquidity, some create long-term business. Since you are building your own businesses, can you think of how you can get benefits from all of these? And when I speak to most distributors, obviously they don't have the wherewithal or the resources to be able to do all of this. So it is important for you to select partners that help you in this journey. And for these partners, you must ask a few questions. Firstly, are these partners helping you create the right, seamless, digital journeys of the future? Second, are they helping you combat online threats? And third, are they helping you grow your business? So from our side, what we are trying to do is we are trying to have very simple day-to-day technology for your benefit. Many of you may have empaneled with us. You would have seen a WhatsApp journey to do that empanelment. The reason for that is it's simple day-to-day technology. I'm not asking you to download a whole new app. I'm just telling you to use this WhatsApp to be able to empanel with us, but even beyond empaneling, to be able to do transactions. Today you can do lump sum and SIP transactions on WhatsApp. We have created a unique QR code for all our distributor partners. Right? On that QR code, if an investor scans, your ARN is already embedded. Right? So you can do transactions on the fly, anywhere. In fact, we had one of our distributors who simply put that QR code up on Facebook, and an investor randomly scanned and made a transaction as well. Right? So you will see a lot of this behavior that will come from your people who are used to doing more and more digital transactions and will require your advice as well. And second, we are also working with creating a distributor CRM where we are building a platform. See, all of the products that you would want to serve your customers with, the group already has. So can I bring all those products into one platform and bring that to your benefit? That is something that we are trying to do. So I'll give you one example of how we have really done this, right? So if you look at, sorry, let me just go back. Yeah. So if you look at most of these partners of Bajaj Finance, right, you will see Reliance, Digital, Chroma, Vijay Sales. Now all of these players, think about their businesses, right? They have to set up very large shops, right? Because you have to stock a TV, a washing machine, refrigerators, microwaves, laptops. You need a lot of space. Right? Second, it has to be in the center of the city. It has to be in an area where there's a lot of traffic. Third, you have to hire good quality people because they have to explain the product. So you cannot just hire somebody off the street, right? You have to train them. All of these are heavy costs. Now, think about who is their biggest competitor online. Somebody comes up with an app, right? On that app, you can scroll, you can see different products, you make your purchase transaction there, and within 3 days, a logistics center from outside the city will deliver to you. Right? How does an offline player compete with this? This is something that our retail partners came and asked us about. So what did we do? We basically looked at the data and we found that one product sells on e-commerce. Only one product. 70-75% of commerce is mobile phones. Right? So we told our retail partners, we have a property called Bajaj Mall. Every month, 2.5 crore customers come and visit that property. All of those customers have an EMI card. On that EMI card, you have your loan assignment and the amount of line that is still available to you. We told all our retail partners, just put your own mobile phone catalog on this website. So next time when a customer comes and he's looking for mobile phones, he only sees those retail partners that are in his PIN code. He does a transaction using his EMI card. Delivery responsibility is the retail partners. Delivery can happen within 3 hours. Even Amazon cannot match this. This is how we work with our partners to create differentiated propositions. So let me share with you maybe just some data and stats around how as a group we have built differentiated propositions, right? See, some of the numbers you will see up are our business growth and the fact that we have built large businesses. But the most important line is the one at the bottom. We have built all of these with our distribution partners. Right? Every single business that we have built in the group has been built with distribution. So it's really very important for us to work with distribution partners, build your capabilities, and take this to the next level as well. So what I will do is I'll just go to the next key point, which is really around, and I'll close with this, the title and the agenda also of today's session, right? Which is update, upgrade, and upskill. How can you do that, right? And how can we help you do that? First, in terms of update, right? Think of new investment philosophies. Think of what is new and updated in the market, right? Think of how behavioral finance is being used. Think of how quants are being used. We're trying to bring a lot of these new philosophies into the market. Think of how you can upgrade, right? And how can we help you upgrade? By creating new products that have some differentiation, that bring new models to the market, differentiated propositions for your customers. We are going to try to do that with every single product of ours. And finally, upskill. What I keep telling all my distribution partners is you all create alpha as well. It is not that only the fund manager creates alpha. All distributors create alpha. If you keep your investors invested, you will create alpha. That is something that you have to realize, and the more you create that alpha, the lesser the discussion is around your commissions and on your expenses. So please focus on these 3 points and work with partners that help you on building up the skills in these 3 points. With that, I will end my presentation. Thank you very much.